So Sherry, I know what you're looking for here, like an easy fix for that. When do I take my CPP question? I would love to see such a thing. In the United States, where the decisions around Social Security are similarly complicated, I know of one calculator, a guy by the name of Lawrence Kotlikoff from Boston University has built a calculator, and it's the only one anybody uses. Yeah. I will show you that I have a spreadsheet, Sherry, but it's not great. The problem is you have to do so many inputs into it still. But yeah, somebody should really build one, and I don't know, maybe one day I will. I don't know. And then the problem is every time the program changes, which has happened a lot in the last 8 years, it makes, and you have to change everything again, right? Okay. And to your question, Bonnie, I know that it's a little bit aggravating right now. You have to go back and find the old Zoom link. I think we solved this problem. So I think sometime in the next couple weeks, you're going to get an email that has an Outlook calendar event for every class with the Zoom link in it. Okay. I think we finally cracked this nut. So, so you should see something like that soon, and then that would save you having to go and find a link. I think for everybody that would be welcome. Okay. So we're not done at all with the financial calculator. There are many more financial calculator problems coming our way. However, we do also have to talk a little bit here about the mathematical concept of risk, okay? And I'm not sure yet. This is something that's actually new to the curriculum, okay, this concept of risk. So I'm not sure yet where this is going to take us as far as the exam goes, but I want to be prepared for what I think are a possible set of questions. Okay, so for those that have gone through the program previously, you might have had a little bit of exposure to these ideas, but not a lot. And here we're going to work through them in a little bit more detail than what you're maybe previously accustomed to. Now, those that do, has anybody, is any CIM on the call? I don't think there is, but any CIM or CFA charter holder? I don't think we have any CIM or CFA. So if you've done either of those sets of courses, you'll be very familiar, and in fact, you'll know more than I do about this stuff. But the, or at least CFA, but the concept here is that we have to have this ability to measure risk, okay? So where this comes from, if we rewind prior to about 1951, okay? So go way back here, prior to about 1951. And what would happen here is somebody who's managing money, so any money manager, would essentially assess risk by their gut feel. Okay, that would really be your risk assessment. There was no mathematical measurement of risk, at least as it pertained to investments. Now, this is where we want to look at what a risk is. So what does it mean to take a risk? What is a risk? So you can think of this from an insurance perspective if you want. Yeah, so it's the chance for a loss, Todd, right? It doesn't necessarily mean there'll be a loss, but it means a chance of a loss, right? Okay, now we'll talk about more of the concept of risk in chapter 12, but fundamentally, it is the chance of a loss. Yeah, an uncertain outcome. So why would I take a risk? So I'm looking for the upside, Todd, right? I've got a potential gain here. So the idea here is that, at least as it concerns investment, okay, so when we're talking about investment, the idea here is that we should only take a risk if the likelihood and amount of gain exceeds the risk. Now, the problem here is that that means we have to have tools to assess those three things. So we need tools to assess the likelihood of a gain. We need tools to assess the amount of gain, and we need tools to assess the risk. Okay, everybody's with me here? And for those that deal with other people's money, for those that have assets that they deal with for their clients, this is always the discussion, isn't it? Is how much risk can we look at here? What's an appropriate amount of risk to take? And why are we taking that risk? Now, as I said, prior to about 1951, this was all measured by gut. People did not have good mathematical models for assessing risk. Now, you can maybe date back a little bit earlier than that. Benjamin Graham, who was a well-known investor, not, by the way, the tight end, Ben Graham, but Benjamin Graham, was a successful investor. He was sort of a tutor to Warren Buffett. And he had some risk management tools, but nothing he could ever really communicate. It was more, and he wrote a really famous book, whose name escapes me right now. But anyways, dealing with how he sort of chose investments. But what ends up happening here is in 1951, a fellow by the name of Harry Markowitz, and some of you know that name. He's actually mentioned in the mutual funds course, for example, and Canadian securities course as well. He develops what's called, or he's part of the early movement to develop the capital asset pricing model. Now, we'll talk about this capital asset pricing model in chapter 10. But basically what it is, it's a way that we can look at the expected return of the investment versus the risk we take with the investment. And that risk generally comes down to the price, okay? So the risk is based on the price of the investment. So is what I'm paying for this thing good compared to the expected return? Okay. Now, there are many different asset pricing models today. So what Markowitz gave us was sort of the first domino, but now we have many, many different asset pricing models. And in fact, this morning, before class started, I was listening to a podcast where they were interviewing Kenneth French, who is a Nobel Prize winner. He and Eugene Fama, and I want to say Robert Merton, I think was the third guy. But anyways, they won a Nobel Prize for their version of an asset pricing model. So There's this is still a very common thing, the idea that we can sort of properly price assets. Okay, that's good. Does anybody want to listen to a podcast with the Nobel Prize winner for asset pricing models? Come on, you're missing out so much here. All right. If you genuinely do, the podcast it's episode 100 of the Rational Reminder podcast. Okay, and it's genuinely good. The guys that host it, they're two guys out of Ottawa, and they're with a money manager based in Ottawa, or actually based in Toronto, but yeah, quite good. Okay, I don't always agree with everything they have on there, but that's okay. I shouldn't, right? All right, all good? Okay, so we're going to look here at measuring returns and risk. We're going to pull a sample data set and look at some of the tools that we can use to measure risk in that data set. We'll also talk about the mathematical concept of standard deviation. Okay, so first off, when we look at investment risk, especially in the mutual funds world, I'll really pick on the mutual funds world here. I guess pick on is not the right word, but what we tend to look at as our primary determinant of risk is volatility, okay? And volatility is really the swings in the value of an investment. So we're going to look at some volatility tools here in a few minutes, but this is how big are the sort of ups and downs of the market, okay, or the investment in question. And of course, volatility has been a big story this year, hasn't it? I'm sure some of you are seeing this firsthand in your client interactions. Lots of concerns about volatility. It seems like every bit of COVID-related news drives the markets one way or another. Is that a fair comment? Okay, co-volatility, Cam? All right, something like that, right? So that's true, Esther, isn't it? Okay. So we have this significant volatility this year. It hasn't always been the case. Man, I don't know what to say about this, Philip. All right. I think there's nothing left that can be said. So that's volatility. And this is really the primary concern for sort of public market mutual funds and ETFs. Okay. And I'm sure that a lot of you have had this discussion with your clients around volatility. This is a familiar line. It's not a loss until you sell. Has anybody said that in the last month? Okay. So really, and I agree with that. I think that's true. I'm not disputing that sentiment at all. I'm not criticizing you for saying it. Okay. That's volatility. When you express that to a client, you're saying, look, client, there is going to be volatility, but until you act on that volatility, it's irrelevant. Okay, that's good. So that's one of our risks associated with investment. And most often you'll see volatility expressed as a chart like that, right? That's volatility. Okay, that's a true story, Philip. Not a gain until you sell either, right? That's the corollary to that comment. Okay. Value at risk is a different concept. And value at risk is the idea that I invest somewhere and my investment falls to zero. Okay, and this is the kind of thing we see typically for less diversified investments. This is what you're going to run into. Yeah, so something like that, Grant. And oh, who do we have in that neck of the woods? Anybody from St. Paul area? I know a few folks. So of course, Briec started in St. Paul, and for whatever reason, then a whole bunch of people from that area bought St. Paul, Alberta, Sherry. So a whole bunch of people from St. Paul and that area loaded up on Briec stock, right? Did you know anybody who did that, Sherry? Yeah, not Minneapolis, St. Paul, sorry. Okay, I knew quite a few people actually. That's I don't know, maybe we have a generational difference here, Sherry. I'm not sure, but yeah, I knew some people who really got hammered on that. Okay, yeah, that makes sense, Bonnie. Just down the road, right? So the kind of just as much as Fort Mac is just down the road from anything, right? So the issue here, we see this with less diversified investments or highly concentrated positions. Okay, and this would be something, for example, so Ryan, you deal in the exempt market, right? You have some exempt market stuff on your shelf. And you would talk to your clients with some of those investments, not with all of them, I know, but with some of those investments, you would talk to your clients. I think I've got that right, Ryan, right? About value at risk, where you could see this with certain types of, let's say, pooled real estate investments, where the investment just does not work out as originally intended, and the investors don't get any money back. That does happen in the exempt market sometimes, doesn't it? I'm not imagining things there. So with value at risk, it's really this idea that you're sort of humming along here, no necessarily even view to, yeah, that's the one that's why I picked on it, Ryan, right? You're humming along, everything's going fine. It might even be a little bit volatile along the way, but then one day, bang, it just goes to zero, okay? All right. So it seems fine, Okay, that's value at risk. And this is generally not a concern for, let's say, the mutual funds or exchange traded funds that are broadly diversified or hold a broad set of investments. If one investment within fails, well, the rest of the portfolio will still succeed, or will still at least survive. But here we have this idea of value at risk. Okay. And then you mean with real estate, Cam? Man, real estate's going to be topsy. I don't know. Again, real estate, man. So then we look at liquidity. So liquidity is the idea that I am without the money in question, the money that's invested. I really give up my access to it. So that is a risk for me. I don't have the money if I need it, or I may have to there may be some fees assessed with accessing it, or I may have to sell at a loss, back to your point earlier, or a couple of you said this, right? Okay. That's good. So those are when somebody invests. Yeah, that's perfect, Grant. An investment like a labor-sponsored fund is typically tied up for a minimum 7-year time horizon, right? Okay. We'll talk about labor-sponsored funds in Chapter 11 for those who, sorry, Chapter 10? Chapter 10 for those who don't know them. All right. But essentially, a labor-sponsored fund is a specific kind of investment where there's a tax benefit, but you only get that tax benefit if you stay invested for 7 years. And therefore, the funds typically have a liquidity restriction at a period less than 7 years. Okay, or at a maturity of less than 7 years. All right. Where are you, Greta? Sorry. Yes. So Todd, a closed-end fund would be a good example where your liquidity risk is higher, right? With a closed-end fund, which is a fund that does not have a ready pool of buyers, subjects its investors to increased liquidity risk. They are typically going to get a better return because of it. But if they need their money before they're expecting to get that, before they're expecting maturity, they may not have access to it. So yes, it's a very good point you raise here, Todd, because these are all where we get risk from. So DSC would limit my liquidity, Sean. It's true, right? That's a fee. So I would suggest that that limits my liquidity. The challenge with DSC funds is, yes, you're limiting liquidity, but you're not getting a better return for it. Is that fair? Okay. So it should always be this trade-off. If I'm accepting volatility, I should get a higher return. Now, it's not to say that I do, I should. Okay. If I'm accepting value at risk, I should get a higher return. Not that I do, but I should. So almost now, Mark, most provinces have banned them, excepting Ontario and New Brunswick. Okay. Yeah, now it's true. Time is an important factor here. Todd, I wouldn't dispute that at all. But it's still the same concept, right? So the idea that time smooths out that volatility, doesn't it?
But if you're going to go into something with higher volatility, time plays a major factor in that.
Yeah, that's right. I generally want more time when I'm accepting that risk, right? So that's because short term, that volatility could hammer me. It's, you know, if we look at my little black graph on the right side here, if I invest right here, for example, and I'm invested just for a short time horizon, well, that investment never really pays off. But if I can wait it out, then I've got a huge chunk of periods where that investment is greater than where I started. So yeah, absolutely. Okay. Okay, so yes, that's the benefit of time. Okay. And liquidity, again, same thing. If I'm accepting a degree of illiquidity, then I should get a higher return. Okay, that's good. Yeah, that's it, Grant, right? Although today, not much difference there, is there? GICs aren't generating much more return and sometimes less return than high interest savings accounts. So it's not always the case. These are not universal rules, but really that would beg the question, Grant, as to why you would use a GIC today. Is that fair? Okay. Yeah, that's a tough one, Mark, right? How do you get around that when you've got so much liquidity lost? And that doesn't just lead to an investment problem, that leads to potentially a tax problem, potentially just a can I pay the bills problem. Okay. Yeah, that's true. If you're talking about the high interest savings accounts available from the big banks, Grant, they typically have pretty large minimums. Okay, that's a true story. All right. Any questions there? Okay. Perfect. Is everybody with me here? Does everybody understand why we care about risk? This is always the question we should be asking, is why take a risk? Okay, that's good. Okay. Now, that being said, Grant, sometimes people take a risk that doesn't lead to a return, don't they? Okay. Yeah, it's true, Stephen. Sitting on the sidelines is a form of risk as well. Okay. Yeah, and that's true, Robert. There's a connection we can make between how much risk has my client taken and what return projections should we be using. Yeah. Okay, or return assumptions should we be using. Okay. Now to that comment, Todd, if you've got a client, and in fact, there was a case like this that I worked on in the capstone course back when we had that course. That was one of the old courses people had for CFP. So this was the case. We had a client, and I can't remember how old she was, client age maybe 73, and she had about $6 million of liquid assets, okay, plus some real estate. She spent about $80,000 a year, approximately, and she had no estate objectives or minimal estate objectives. It was about $1 million that she wanted to leave to her kids, or actually nieces, they were. So how much risk does she need to take with her investments? Single, Philip, she is single, yeah. Good question. Yeah, why would you expose somebody like that to a lot of risk? Okay, that's good.
It comes down to what the client wants for income. So if it's 80,000, yeah, that's simple.
This should not be a complicated investment decision, should it? Okay. No. Right. Now, Ryan, there might be other things here. Maybe she needs a little education on what she could be doing with her money. Who knows? But just with this bare set of facts, I would not want to put her into overly volatile investments. I would not want her to have a bunch of that $6 million at risk, and I would not want to limit a lot of her liquidity. Okay. Now, that being said, there might be other reasons to limit liquidity. Maybe we like a liquidity restriction because it forces her to only spend at that planned rate. Okay. So there might be other reasons to do this, but strictly from a risk perspective, this is it. Okay. Yeah, that's it, Grant, right? And with a scenario like this, you probably do not need to do a lot here. Actually, Bonnie, you know this client. You did this case study. Okay. Yeah, and fine, Cam, if I'm 40 and I'm counting in my investment assets to load up my returns, I need that. Yeah, 5 to 8%, go ahead. But if you're 73 and you got $6 million, you don't need it. Okay, unless you had some elaborate estate objectives or whatever the case is. Now, no, that's good. All right. Yeah, and that's just simple math, Robert. You don't need your financial calculator for that, do you? And that assumes she lives quite a long time, right? In fact, Esther, I'm a big fan of that type of plan. I would still invest it, Robert. I just wouldn't take a lot of risk with it. Okay, so we can look at investment risk here. And the most common place we look at investment risk until we really get comfortable with the concept is in the stock market. Okay, and in fact, we already heard a crack about this today. I think you said the Dow was down 300 points in a half hour or something like that. Wasn't that the comment we heard? Okay, so what we're looking at here, and I have a more, yeah, see, this is why I don't pay attention to the market, stud. Because first off, I don't have clients with investments. And secondly, because a lot of it is chatter, right? Noise, whatever. Okay, so now in your shoes, I would pay attention to the markets because I know people care about it. But man, I would try and get my clients weaned off of that. So this is what's called the TSX Composite Index. Okay, what this is, and it's an index. So an index in this case means that it's a sort of artificially structured portfolio with a representative basket of securities. And the idea here is that this is supposed to represent the overall sentiment for the Canadian stock market. Now, some people would say the economy, but I'm not a fan of that. And we talked about that back in chapter 2, where we said this is a leading indicator, but that's all it is. Okay, and you see this argument quite a bit today is, you know, the stock market is not the economy or some version of that. So the idea here is that this basket of securities, sorry, not basket of securities, is supposed to give us an idea of the direction that Canadian publicly traded stocks are generally moving. Okay, now there are many indexes. The best known index is the one that was already mentioned, what's called the Dow Jones Industrial Average. Or DGIA. Okay, and it's probably the easiest one to understand because it actually only comprises a very small number of securities. So and it's about 150 years old now. So it has 30 securities in it, 30 stocks or companies. They're all essentially the same term here. And the idea is that it represents the US economy. So the idea here is the securities that it holds are supposed to be sort of useful indicators of what's happening in the economy. Now, it's not the same companies that are in here that have always been in here. So for example, you can look at former Dow Jones companies. And the one that, of course, you always hear about here is Kodak. Everybody loves to talk about Kodak because it had a massive increase in growth and then went down to nothing very quickly. But we can look at other companies. Alcan, the aluminum company, used to, of course, be a Dow Jones company. And now that we've seen so much of that type of manufacturing leave the United States, it's a lot less prominent. And then you have companies that are clearly newer than 130 years. So today we have, for example, Google and Alphabet in here. Or sorry, Alphabet is Google. That's what I meant. And Microsoft, for example, as Dow Jones companies, or Apple for that matter. So the idea here is that it's always supposed to look like the market. Okay, kind of like we talked about before when we talked about consumer price index and how there we have this index that tries to track household spending. Well, here we're trying to create an index that shows us what's happening with publicly traded companies. Okay. So when we see this index price go up, it generally means that companies are increasing in their perceived value. Okay, so investors are looking at that and watching that perceived value increase. And you see what happens here. I know some of you know this story well, but I chose 1988 here to represent. And you look at all the way from 1988 until, of course, 2008. And we have nothing but just steady growth, a little bit of a dip here in 1991 in Canada. That didn't happen in the United States, but we have a little dip here in 91 in Canada. But really from 1988 until 2008, just that steady growth. And there's a little bit of volatility in there, but not a ton, right? And then you get these periods here and there with some dips in them. Okay, well, we get a little dip in 1999 owing to long-term capital markets, but again, not a big deal. All right, that's all good. So every year we look at our gain or loss. Okay, and percentage gain or loss. So this just tells a story of what happens in the markets. And the overall message that most people will take away from this, I think, is that if we take a long enough time horizon, ties into your comment earlier, Todd, if we take a long enough time horizon, these little dips that we see here and there, even the big dips we see here and there, even something like a 35% loss in 1 year, doesn't really mean that much if my time horizon is long enough. And you can look at how long does it take for that 35% loss to come out? Well, if we're at 13,000 points, 13,800 points here at the beginning of 2008, it's not until 2014 that we end up back to that level, but it's not really that long a time, 6 years. It's a long time if you retired at age 65 in 2008, but other than that, it's just how it goes. Okay, so I'm actually going to pop over to an Excel spreadsheet in a couple of minutes here to have a look at this. But when we measure risk then, there are several tools that we can use to measure risk. So we can look at the range of returns. What are the returns in the period in question? What are the best and worst periods in the period in question? How many bad years did I have? If there's a drop in value, what did that drop in value look like? And what did my peaks look like? So let's pop over to Excel here. Okay, are we all looking at an Excel spreadsheet? All right, so what I have here, I actually don't remember what index I pulled this from. I want to say I have, yeah, TSX. So this is the Toronto Stock Exchange The TSX figures the closing index price for every year from 1945 until 2019. Okay, and this is the kind of thing we can use to show somebody what their risk looks like. So, man, I can't believe what I've done here. But anyways, we can pick any given period from 1945 until 2000 and what did I say? 19, and we can do a little bit of an assessment of what the risk looked like. And I think that the benefit of being able to do this kind of thing is that we can show that risk really does look pretty much the same in any given period of sufficient length. If I pick a 3-year period, any sort of 3-year period is probably not going to look like any other 3-year period. But if I take a 12 or a 15-year period, generally speaking, it's going to look like any other 12 or 15-year period. Okay, so I don't know, does anybody care what years we use? Yeah, now part of the benefit, Grant, of those fully diversified portfolios where you take into account sectors and fixed income as well, is that you have some ways to manage some of this risk, right? You end up essentially taking some of the risk out of the portfolio. Yeah, this is TSX, Mike. Yeah. Okay. Do you have any 2 years you care about here, Mike? All right. Yeah, it does get tougher there, Grant. Now that you do have indices to deal with that, okay? So we talked about stock market indices, but there are indices for balanced portfolios, for example. There are global indices. All right, Philip, thank you. All right, 1986 to 2006, okay? So this is where in that time frame that Grant or that Philip has chosen, sorry, the lowest return for that 21-year span was negative 18%. And I think we probably know where that happened. We had an 18% loss here in 1987. We can go down and have a look at that. Oh, no, sorry, I apologize, because 87 had the recovery too. I apologize, 1990, look at that. Okay, so problem with assumptions, eh? So then our best return, a 30% return, and that means that the range of returns here is almost 50%. So an investor who was only invested in equities, only in Canada. Well, that's why I asked you, Grant, to give me the years. You see? Because I didn't want to fudge the numbers here. But yeah, you sure could. That's why I also think that it's good practice to look at a few different periods. So, we can look at this period, 86 to 2006. Maybe you want to choose a period that had 2 big crashes in it. Okay. During that span, so my worst year, 1990, my best year, 1999. 6 years of losses out of that 21-year span. Okay. Yeah, it's true. So we could point to both of those periods, although 9/11, let's have a look here what happened in 2001. Yeah, down 14% and then 14% the year after. Yeah, that's fair. So of the 6 losses, the average loss was a 10% loss. So, hey, that's something useful. And I think back to your comment, Grant, by choosing a long enough time horizon, I have some meaningful losses in here. I say, look, on average, yes. So we'll talk about that, Grant, a little bit when we talk about fund risk in chapter 10, because And it's worse than that. It's actually worse than what you're talking about. It's because a lot of them are only 5-year histories. That's a problem, Sean, right? If you have a fund today that now today again, but if you go back to January 1st and you're looking at a fund that only had a 5-year time horizon, you've got an inception date problem. You've never had a bad period until now for that investment, right? Okay. That is an upside, Grant. I do like that. What I would really prefer here is that we have a 20-year time horizon for assessing risk. I find that 5-year time horizon, that is going to hurt investors, and we're going to see some of that right now. Okay. Yeah, I get that, Esther. Who knows, right? Okay, who knows what's going on there? All right. Largest drop in value here, 18%. We already talked about that. So then, this is actually not perfect for this period. I have to I'm not good enough with Excel to have done the maximum time between peaks. I know there's a way to do it, but I couldn't get it. But anyways, the maximum time between peaks would tell you what the longest span from one drop till the next peak was. Okay, and I can go through and calculate it. I don't think we need to, but it's just a matter of averaging that out, and I have to identify the peaks down here to do that. Okay. Oh, as I think about it, I could have done something smarter down here. Okay, anyways, I could use a largest function there. I didn't think about that. Now, this kind of thing, this kind of analysis, this is really what my personal thought here, your fund managers should be providing you with. I think, Grant, to your comment, sometimes we get skewed numbers that way. If you want to do it yourself, you can build out your own Excel spreadsheet, or mine is posted up here. It is a nightmare. Okay, this is a very complex Excel spreadsheet. You can see the type of formula that I'm running up here with 2 different sets of index functions. Index is something you couldn't even do in Excel until 2013. So you get some fairly complex formulas to try and run this kind of thing. But it is possible to get Excel to do this. You could eyeball it. Everything I did on here could be eyeballed, but it's a little more difficult. Okay, so these are different, again, ways to look at risk, how much risk you're facing, and when you have a risk, what then does a recovery look like? Okay, and then the other Excel spreadsheet that I want to show you related to risk here. Hiding on me, there it is. So this is standard deviation. Okay, so this guy right over here, and we saw one of these before. This is what we would refer to as a bell curve. And this is a bell curve with a standard distribution, or normal distribution. Okay, that's it, Philip, right? So the bell curve is just a way to represent data. Yeah, and we've all been curved out now, haven't we, Philip? So in this case, I have a sampling of returns. Okay, and in fact, what I did here is I took, I want to say that's the S&P returns. I'm pretty sure that's, yes, that's S&P returns from, I think, the period that I showed on the board before. But anyways, sorted them all from lowest to highest. And that's where we can then use Excel's functions here, Excel formulas to calculate the average, the mean. So I just add up all the numbers and divide them by the number of numbers. And then this concept of standard deviation. So what standard deviation is, and that's the little, what letter is that? I can't remember what letter that is. But anyways, that's standard deviation. And my brain is failing me right now. But anyways, my standard deviation of 15.5% means that the average is 6.22%, but most times, about 70% of the time, I will expect my performance to be somewhere between or somewhere within 15.5% of 6.22%. So again, looking to our bell curve over on the right here, my average is right about here, sorry, at 6.22%. Okay, that's good. And then what we call the first standard deviation, which is where the majority of our returns sit, is going to be right about here. So that first standard deviation. And that means we would drop by 15.5% from that 6.22%. So my first standard deviation on the left side is 6.22 minus 15.5. Which is negative 9.28%. And to the good, my first standard deviation over to the right would be 6.22 plus 15.55%. Sorry, 15.5%. So 21.72%. And that's where I would find the bulk of returns, the bulk of our results clustered. So this is actually about 34% on the left side and about 34% of returns on the right side. We would expect to sit somewhere between negative 9.28% and positive 21.72%. Now, what would it mean if I found an investment with a similar return average, so also 6.22, but a standard deviation of, let's say, 11%? Okay, so this guy presents less risk, right? So the green fund presents less risk. In this case, and exactly that, Todd, measured in terms of volatility. Okay, this is exactly what we're measuring. So knowing only this information, if this is, let's say this is the only material information about these two funds, I've got one that averages 6.22% with a standard deviation of 15.5, and I've got another that averages 6.22% with a standard deviation of 11. Which fund should I choose? Which investment makes more sense? So assuming again that this is the only material information, it has to be the 11%. Okay. I'm getting that. I'm getting the same return with less risk. And again, going back to that question of why take a risk? This guy is giving me the same projected return at less risk. Okay, there is no reason to choose the whatever the blue fund or the blue investment. Okay, it only gives me risk, it gives me no extra performance. Okay. No, that's true, but past performance is also the only thing we have to go on here. That's where I say this is the only material information that we have. Okay. That's good. Yes, nothing like looking at the very short term, Mark, right? Yeah, that's the message here, Esther, is standard deviation is the best description of at least volatility. And volatility is the most important risk for well-diversified equity investments. Okay. Yes, because definitely, Mark, if it did 20% last quarter, it has to do 20% this quarter. Okay. That's good. Nice. All right. I don't know if that hashtag is deliberate, but it should be. Okay. The 34%. Yeah, so that's just that when we talk about a normal distribution, Shade, that's what that means. It means that I've taken 34% of the data and parked it in that first standard deviation, or 34% of the returns in this case, and parked them on that side, and 34% and parked them on the left side. Okay, it's a statistical tool so that every bell curve shows the same thing. That's good. Okay, now things don't always work like this. Okay, this is actually not necessarily representative of reality. Okay, and I will use, so as much as I'm not necessarily a huge fan, I like his book, but Nicholas Taleb or Nassim Taleb, do we know this guy? He wrote The Black Swan and Anti-Fragile and Skin in the Game. Turns out he himself is incredibly volatile. So watch his Twitter account. Sometimes he gets super angry at people, swears at people, calls them morons in all kinds of interesting ways. But anyways, he makes this argument, and he's not the only person to make this argument, but he says, look, standard deviation actually doesn't really tell the whole story. Because if I look at human heights, right? So if I look at heights of adult humans, the average here, yeah, that's a problem, Esther. That's a data problem. You're right. I'm going to look at heights of adult humans. This is a useful example, I think. So the average, I don't actually know what it is, but let's say for the sake of argument, it's 5'9". Okay, that's good. But the minimum here, I don't actually know, something like 2.5 feet, right? And the maximum is something like 8 feet. Is that fair? I'm pretty close there if I'm not exactly right. That's about what it is. But if we follow a proper standard deviation model, if we were predicting human heights here, Nice, Grant. So if predicting human heights via a standard deviation model, first off, there would actually be no limit to people's potential shortness or height. So we would have people shorter than 2 foot 6 inches and taller than 8 feet. And the other thing that we would see here is we would see a whole bunch of people, or we'd see a wider distribution of people out on the tails. So we would see many more people who are between, let's say, 3 and 5 feet tall, and many more people who are between 7 foot and 8 foot tall. So it's not 8 inches, but 8 feet, sorry. So it's not a good indicator for every possible set of data. There's lots of stuff that doesn't fit in here. Yeah, except that it's really the vast majority, Esther, that fit within that first standard deviation. It's well over 68% of humans that fit into the first standard deviation off of 5'9". That's good? Okay, so that's where this doesn't always work. It's not always a great model, but it works for lots of things, and it's the sort of standard model that we use for tons of data, including, incidentally, marks on the CFP exam. Okay, that's good. Not passing on the CFP exam, but marks on the CFP exam. Okay. All right, so to your point, Esther, yes, mutual funds will tell you what their standard deviation is. Okay. And you can use that standard deviation then as something of an assessment of risk if we use volatility as a proxy for risk. Okay, that's good. Now we'll just pop back to PowerPoint for a moment here. There it is. And yeah, I have the actual distributions here allocated right. So my exam question around this, Stephen, the question that I would ask you, wouldn't necessarily make it obvious that you're dealing with a standard deviation question. Okay, so you're going to see something like this. You're going to see that I've got Fund A, and Fund A had an average return of 7.2% over the last whatever 15 years. Okay, just for the sake of argument. Okay, and you might not be given the standard deviation, but you might be told something like this. You might be told that its lowest return in that period was, let's say, negative 22%, and its highest return was, let's say, we're going to do 30.4%. Okay, something like that. And then Fund B, and it maybe had an average return of 6.1% over the last 15 years. With me here? So same time frame, and the lowest return in that period was, let's say, negative, let's go 13.4%, and the highest was 21.5%. Okay, and then I'll give you a little portfolio or a description of an investor. Okay, so we'll describe the investor. And there will be something in here that points to either a lower or higher tolerance for volatility. And then you're going to choose one of those two funds. So the idea here would be that sort of that lowest and highest return would be a proxy for volatility. and then you would be able to match this person. Okay, so you might match the investor to the fund. It's honestly not, though. I know it looks like it based on this example, but it becomes a matter of really reading into the case study and finding something in the case study that would help you to identify this person's ability to tolerate risk. Yeah. Right. So some investors are going to prefer that, Esther, right? Some investors would prefer less volatility. And some investors say, that's fine, I'll ride out those ups and downs. Okay, that's good. So maybe the detail that shows up here, and it might be a trade-off type of thing. So maybe I have an investor who rode out the 2008 market volatility. So this person had no problem in 2008. So that might point to Fund A. I think that's fair, right? But this person is now, let's say, 2 years from retirement, and their own spouse has already retired, and that might point to Fund B, right? Maybe, depending how it's phrased. So it wouldn't be unusual that you have to navigate that. Now, we're not, I think, fully ready to have that conversation yet. That's something we're going to come back to in chapter 10, chapter 11, chapter 14, chapter 16. Yeah, so that's often the case. So really, Stephen, just like how time value of money is going to work its way into other questions, this is going to work its way into other questions. So you won't have a straight up standard deviation question. You'll have a question where you have to recognize what that standard deviation represents. Okay. Okay. Yeah, absolutely, Bonnie, which is exactly the problem that Grant was pointing to earlier, right? So what Grant talked about earlier was that funds have had their, and many of them have very short periods since inception, funds have had the ability to reassess their risk based on just what they've done in the last 5 years. So what you have now is many funds that are really high risk funds, but because of how our regulation is written, they are able to recharacterize themselves as lower risk because their returns have all been over here. If I've been able to pile up my returns, whether it's a 5-year time horizon or a 10-year time horizon, but if all my returns are positive, that's going to skew my results to the right. Okay, and that's where we see many funds that have had a really good 10-year run with no losses now show less risk than they should. Okay. Yeah, there's no way to completely eliminate risk, Bonnie, right? It's just not possible. Okay, we want to choose the right risks for the investor. Okay, that's all good. Okay, now we do see other examples of risk. So again, going back to Nassim Taleb, he makes this argument. He says what we tend to do is really ignore what we sometimes call our tail risks. So his suggestion here is that, in fact, there's more likelihood of events at the tails than what statistical modeling shows. And there's some value in this for folks that live in the insurance space. Okay, really, the stuff that sits on the far left here, this is mostly what we're insuring against. Okay, this is a total loss house fire. Not a very common event, right? Total loss house fires are quite rare today. But when they happen, they have a massive negative effect on the person who went through that loss. That's why we have home insurance. Okay, or we're insuring against a permanent disability here. Or we're insuring against premature death. And the problem here is these risks, we sometimes call our fat tail risks, because this tail should be really fatter than it looks like here. People don't recognize that this is stuff that can really happen to them. And in fact, we find that most people live their lives as if everything is going to sit in this first standard deviation. This is why people often have inadequate emergency funds. This is why people often don't carry enough insurance, is that this is where people assume their lives will be lived. Okay, and why not? I've had a job every day for the last 10 years. Of course, I'm going to have a job tomorrow. Or I've not been seriously disabled every day for the last 10 years. Why would I be disabled tomorrow? Or whatever the risk you want to point to is. That's fair? I saw a really good example of this actually in the CBC News yesterday. Anybody read this story about this guy in British Columbia who opted out of the medical services plan? I didn't even know you could do this actually. Yeah, so up until January 1st of this year, you had to pay premiums in British Columbia to opt out. Sorry, you had to pay premiums in British Columbia to participate in the medical services plan. I assumed it was mandatory. I thought you had to pay. But this guy decided he was going to opt out. He said, I'm not getting anything for it. So he figured he'd take his $38 a month and save the expense. That's exactly it, Grant. Lo and behold, in the period when he's not covered by MSP, he's diagnosed with cancer. Yeah, it's devastating, isn't it? Now, if that same thing had happened in the United States, add a zero at least to that amount, Grant, right? But still, for $38 a month, that is a terrible financial decision. Okay, that's good. I'm honestly shocked that you could opt out of it. I had no idea that was possible until I read that story. It was super short, Stephen. It was less than a year, something like that. It was nothing at all. Okay. You mean people die without life insurance, Todd? Is that what you mean?
Yeah, you see it on TV. They got either some fund at the local pub or something going to raise money for the family because they couldn't afford that $20 for some term insurance for the wife and the kids.
Yeah, that's the GoFundMe thing, agreed, or the steak nights back in the day, right?
Yeah.
But yeah, this is, I mean, this guy had to actively choose not to pay his MSP premiums. Yeah. I believe he does, Shauna. Yeah. All right. I'm not in the habit of, I think we talked about that once before. I'm not in the habit of funding GoFundMes. All right. Okay. Yeah. All right. And especially Shauna, because you spend your life trying to get people to properly manage their risk, don't you? You're now a couple decades into that that practice. I know that. You know people should know better, right? Okay. Are we good there? Yeah. Shauna, I'm with you. I'm with you on tenant insurance. That is a bad risk that people take when they go without tenant insurance. And that's nothing. 40 bucks a year for tenant insurance. And the risk that you expose yourself to. Okay. To go to the dentist. Wow, that's hardcore. Okay. Perfect. But it is just this. It's this problem where we live in the middle, right? It's what we get used to. So if yesterday was a normal day, tomorrow is going to be a normal day. Okay. Can we wrap up there? It's a pretty full day. I think people probably don't need a lot more to stew on today. Is that fair? Okay. Now, I'll just show the financial calculator practice stuff again here. I was glad when I put the polling question up there this morning that a lot of folks were doing some financial calculator practice. So now you'll be able to do in chapter 5. There is this little video, actually, you might find it helpful. Then there is that's the 2-question quiz, the little quiz that I went through. So we're not into wealth at all taught until chapter 10. Okay, so really this is just about risk, and we'll do the wealth stuff in chapter 10. Yeah.
I wanted questions just on like what we did today, where you have to read the story and figure out where the stuff goes, because when you do those questions, it's already in there. You just plunk it into your calculator. I want ones where you have to try and figure out what goes where.
So actually, if you pull today's blank PowerPoint deck, there's some questions in there that we didn't go through. There's a big retirement question still in there that we haven't done.
Okay. I'll look at.
Yeah, so that blank PowerPoint deck is, what are we on here, day 6. So if you pull the blank PowerPoint here, sorry, I got the thing up here, right there, day 6 a.m. financial calculator applications, you'll find, lots in there still. You can definitely do the 2 time value of money assignments now. Okay, chapter 5, both should be available to you. We've done similar enough questions to both of those. Okay, I will comment with the Tim and Melanie one. Don't overthink this. Okay, it is 1 time value of money question, just like the template implies. Okay, it's not 6 questions or whatever. Good. And then you can do the chapter 5 quiz. All right, and when we're together next, we have the law stuff, and we'll probably start the day. I think I'll do this with 1 financial calculator question. There's time on that day to do it, so we're good there. Okay. Sorry. You know what I'm going to show here real quick before we wrap up is, I said it was pretty easy to do time value of money in Excel. Okay, so this is an example of an Excel spreadsheet that does a time value of money calculation for you. And there's lots of stuff that I could have done with this. So this is one where you input all your variables. So let's say that we have somebody who's investing and earning 6.5%. Oh, some decimals in there. Okay, inflation is, I did that. Inflation is 1.8%. This person makes whatever, $80,000 a year. Okay, they're going to retire at age 65. They're currently 48, whatever. You see how every time I change one of these numbers, we get a different outcome. So that's just Excel tweaking the formula. So that tells you, at least here, it's just a simple future value calculation that takes into account all of those variables to describe for us what the income needed in year one of retirement is. That's a, you can see it's a future value calculation, and it looks very much like what you do in your financial calculator. Oh, do that to be Excel. Sorry. Looks very much like what you do in your financial calculator. You put in a rate, N is number of periods, payment is payment, present value is present value, and type is begin or end.
So when you do that, do you have to input the formula, or is it already done?
So if I do like this, if I'm going to solve for present value, for example, right? So you type equals present value. That's how Excel knows you're doing a formula. And then you would put in all of your variables. So you can do,
Okay.
yeah. So it sort of walks you through it. I have somewhere, I might plug it into chapter 5. Somewhere I have a how to do financial math in Excel, but I don't know if it's sitting in chapter 5 right now, but I'll look around for it. Okay. I think it's a wonderful tool. I think that everybody should know at least a little bit of Excel. It does all kinds of things that you would never think about. I have whatever I'll show you here. Now you got me down a path here. There it is right there. This is the one that we chatted about before. So this is a sort of break-even calculator for the Canada Pension Plan, but it's not perfect. I got a few things I got to tweak in it. Even then it won't be perfect, but you can do, yeah, what's your CPP max? What would be at 65? Tax rate, what's our discount rate? See, everybody's favorite. And then based on changing all of these things, I can plug this in. So this thing is actually doing, okay, yeah, it's crazy, Philip, right? The stuff that's in there. And yeah, I agree. And that's why you can pause, right? It's nice to pause that. So so whatever the CPP max is for this year, $1,300, and this person's going to retire with, let's say, 1,050 of that. And you can see what happens down here, okay, is every time I change one of those numbers, so now I'll change that to $1,010, watch the calculations happen. So Excel just did, in the time it took me to do that, whatever it's going to be, 180 time value of money calculations. Okay. So you can tweak whatever number you want and it adjusts accordingly. Okay. That's good. And the numbers are all in there. I just have some hidden columns. So. Okay. Lots of fun, right? Yeah, it's true, Stephen. You can fast forward in YouTube. I know some people like that. All right. Enjoy, Philip. All right. Okay, so we're on again in a week, right? I think that's true. June 4th. Okay. And, oh. So, Robert, can you email me with that question and give me a little bit of what you're looking at? But yes, I think that's good practice, honestly. Yeah. Yeah, Jason at businesscareercollege.com. And we can talk a little bit about what you're looking for there. Yeah. Just give me 1 second, Robert, okay? I just got something here, but yeah, and I'm not sure. Sorry, I apologize. everybody else who had a question is ducked out. Okay, yeah, I'm going to stop the recorder anyways. Just give me a moment. I'll just be right back.